Daniel Morris, you've got a brilliant short note, and I love the single sentence. Fund flows are actually negative. Describe how fund flows are negative.
Well, I've been seeing at least a lot of reports from Southside Research highlighting how euphoric, toppy, frothy, pick your adjective, the markets are, and they show different indicators. Illustrating that in one in particular I saw showed a subsequent, 12-month forward negative returns likely for the S&P. So we looked at some of the components of those indices, and one of the things normally that goes into it are fund flows. And the parallel is 1999-2000, when you had the tech bubble and you were selling whatever you had so you could pile into equities. And there were huge fund flows into equities and into tech during that bubble. You don't see that now. You haven't had really inflows into equities all of last year, but even more recently, with this turn, even from the vaccine news, you maybe would have anticipated retail investors who we know have a lot of cash on the sidelines, have bought a whole lot of bonds, would say, hey, this is a great time to move into equities. That's not happening. So to whatever it is that is pushing the markets up, it's not just pressure from cash having to be put to use.
And here's the thought for the weekend, folks, for Global Wall Street. You nailed this, the partial differential of the put-call ratio. Daniel Morris, you talk about the speculative enthusiasm of a lot of buying of calls, optimism, versus the dynamics on the put side as well. Is that speculation separate from institutional long-term money, or do you combine them together?
Well, you certainly want to look at both, but I think that there's certainly a difference between having an option on market upside, which I think makes complete sense in this environment. There is potential for positive surprises right now. And separately, if you looked at actual asset allocation among institutional investors, you're not going to find a huge overweight to equity. So I think it is an important distinction to make between options on some potential upside and investors, generally speaking, being excessively exposed to equities, which, again, we don't see to be the case.